Okay, so let's talk about the economy right now in 2026, because honestly, it's sending some seriously mixed signals. In this explainer, we're going to dive deep into what I'm calling the great contradiction.
To get us started, I want to kick off with this quote from financial analyst Andrew Lokanoth, because it just perfectly nails the moment we're in. Everything you think you know about the economy is wrong. Whoa, that's a really bold statement, right? But stick with me, because as we're about to see, the data, it might just back him up.
So what exactly is this great contradiction? Well, you can think of it as a tale of two completely different economies. There's the one we're all hearing about in the headlines, and then there's the one we're seeing in the cold, hard data. Yeah, check this out. On one side, you've got these super rosy headlines, right? The S&P 500 is soaring, nearly at all-time highs. Tech companies are pouring, $700 billion into AI? The Fed is telling us inflation is cooling down. Sounds great. But then you look at the other side. The actual data tells a totally different story. The job market, it's at recession levels. Those big tech stocks, they're crashing. And the US dollar, it's at a 4-year low. So how on earth can both of these things be true at the same time?
And look, this whole contradiction, it really matters. And it matters for one simple reason. You, the consumer. I mean, just look at this number. Consumer spending is the engine of the entire U.S. economy. We're talking a massive 70% of all GDP. So if that engine starts to sputter, it honestly doesn't matter how great the headlines sound, the whole system is in some serious trouble.
All right, so let's dig in. Let's start looking at the actual cracks in the foundation, the specific data points that are hinting at a pretty big slowdown.
Okay, first red flag, you're looking at it. 1.4%. That was the GDP growth for the last quarter of 2025. Now that might not sound terrible in a vacuum, but think about this. It's a huge drop from the 4.4% growth we saw just the quarter before, and it was way below what anyone was expecting. It's like the economy just slammed on the brakes, hard.
And then there's this beast, the trade deficit. For the full year of 2025, the U.S. imported over $900 billion. That's billion with a B, more than it exported. To put that in perspective, this is one of the largest trade deficits we've seen on record, going all the way back to 1960. That is a huge drag on the economy. Okay, this next number, this one is absolutely crucial. 0.87. So what is that? That's the ratio of job openings to unemployed workers. Think about it this way. For every 100 people out there looking for a job, there are only 87 jobs available. We are officially in a job deficit. And to really put that 0.87 number into perspective, check out this chart. It's actually lower than the peak of the dot-com recession back in 2001, which was 0.90. So, by this one key measure, the job market is actually weaker right now than it was then. That's pretty sobering.
Now, this weakness in the job market, it's creating another really worrying trend. So let's quickly define a term you're going to hear a lot: long-term unemployed. Pretty simple, really. It's anyone who has been actively looking for a job for 6 months or longer.
And as you can see right here, this is becoming a massive problem, a full quarter. 1 out of every 4 unemployed Americans falls into that long-term category. We're talking about 1.8 million people. Now, this is highly unusual this far into an economic recovery, and it really signals a deep structural problem in the labor market.
Okay, so we've got all these different data points. How do they all connect? Let's take a look at the ripple effects and the kind of dangerous cycle they're creating. It really starts with that weak dollar. It creates this vicious cycle. Here's how it works. First, a weak dollar makes all the stuff we import more expensive. Okay, no surprise there. But then, those expensive imports, they fuel inflation. And to fight that inflation, what does the Fed do? They have to keep interest rates high. And those high rates, they slow down the whole economy, especially things like the housing market. And that hurts everyone. It's a really tough cycle to break out of.
So, if the economy is flashing all these warning signs, you have to wonder, what are the most sophisticated investors doing about it? Let's follow the smart money and see how they're positioning themselves.
And when you talk about smart money, there's really no better example than Warren Buffett. You know, the key thing to remember about him is that he anticipates markets. He doesn't just react to them. His moves are almost always early. So whatever he's doing right now, that's a bet on where he thinks things are headed.
So what did he do at the end of 2025? Well, he sold off a massive chunk, 77%, of his Amazon stake and trimmed his position in Apple. So what did he buy? He opened a new position in
the New York Times. Now, this is a really clear shift, right? He's moving away from those high-growth big tech names and toward more traditional, value-oriented companies. Think established businesses with steady profits, trading at what seems like a fair price. It's a classic defensive playbook.
And hey, it's not just Buffett. We're seeing a broader trend here. A lot of smart money seems to be rotating out of the US and into Europe. While the S&P 500 is kind of struggling, markets over in Europe are actually hitting record highs. It looks like investors are chasing value in international markets.
Okay, so with all this going on, what does this actually mean for you, for your portfolio? Let's lay out a bit of a framework for how to navigate this uncertainty based on the advice from our sources. All right, here's a 4-step framework to think about. First, strengthen your defenses. Consider assets that tend to do well in a slowdown. Things like bonds, dividend stocks, utilities, and healthcare. Second, think globally. Maybe explore diversifying with about 10 to 20% international exposure, maybe 3 ETFs. Third, it's time to question big tech. Make sure you own those stocks for the right reasons, especially with all this concern about their massive AI spending. And finally, and this is maybe the most important one, watch the labor market like a hawk. Right now, it is the single most important economic signal to track.
So there you have it. The headlines are telling us one story, but the data seems to be telling a completely different one. The economy is sending a really clear signal of a slowdown. The only question is, are you listening?